In this week's video, we're going to go over another article I wrote last week. Seemed to be some good reception there, so I'll continue to do this, going over these articles that I've written. What we're going to talk about is year-to-date anchored VWAP, some study and some math that I've done with that, and go into some charts and try to talk about how I would use this to actually trade practically with some live swing trades going on here as well. So first of all, going to be a shout out to, let's just grab that, Brian Shannon's book here, Maximum Trading Gains with Anchored VWAP. That's where this idea came from. There'll be more Anchored VWAP content, I'm sure, on the channel, me doing some cool math with it. So stay tuned for that. Like, subscribe, all of that. Link to my website in the description below, and that will get you access to basically my thoughts on the market every day. You know, more of this kind of content as well. You can sign up for this email list there as well. So let's just get into it right away. So first of all, what is volume weighted average price? What is anchored VWAP? If you want to go into detail, I highly suggest the book. But basically put, it is a line that tells us what the average price for whatever the moment that we've anchored it onwards is. So in this case, we're going to talk about year to date. So every time I talk about the year to date AVWAP, I'm basically just saying, what is the average price of the average market participant from January 1 to whenever we're looking at it. So if we go into the screen here, basically, you know, I'm not going to just read my article here, but what I did is I took from the last video that we did and the last Substack that I wrote, the slope of the moving average, and basically said, hey, we're just going to buy the SPY as long as the moving average is sloping higher, and then we're going to get out when it slopes lower, kind of thing, and showed that we can actually do pretty well. We don't beat the market in percentage return, but what we do is we do a really good job of staying out of drawdowns and staying out of, 2008 and staying out of 2001 and all the times the markets got really, really bad. And then basically we talk about how if we can scrap that for now and go look solely at anchored VWAP, is there any predictive power to this year-to-date anchored VWAP? Because as a person who uses statistics and combines those with technicals, I always want some sort of some way to prove to myself that this works and that whatever it is that I'm going to trade makes sense. That's why I called my website Stats Edge Trading, link in the description below. But it's because I use some statistics to kind of elevate myself above people who will just use charts or just use fundamentals. I want to kind of combine the disciplines of saying, I know that these things are going to work and that looks good. But I want to also make sure that, that there's something that I can point to, something that I can prove. So I did a simple test and I said, hey, we're going to buy the S&P 500. And we're talking right now about this chart right here, but we're going to buy the S&P 500 when it's above its year-to-date anchored VWAP, and we are going to short when it's below. And we actually do a pretty good job just with this simple strategy as well. Some pullbacks back where the market chopped, but taking this and just adding it to whatever a buy and hold approach would be, we suffer less drawdowns. We have less upside, but we also suffer less drawdowns, which is major part of a trading strategy for me. And then I say, okay, what happens if we try to smooth our results? And I do that by saying I'm going to buy the SPY when the 10-day moving average is above the year-to-date anchored VWAP, and we're going to sell when the 10-day moving average is below the year-to-date anchored VWAP. Again, as a way to just say, instead of buying every time something breaks above the year-to-date anchored VWAP, breaks below the anchored VWAP, this is my way of adding a little bit of smoothing and discretion to a systematic trading style. Now, I'll explain why I said discretion in a bit, because again, this is purely systematic, but we'll go into some individual charts and take a look at that. But when we take a look at this, we can see it boosts returns dramatically. And then it also does a much better job of staying out of these sideways markets. You can see how in 2001, the SPY dropped dramatically and we just went sideways. And then again, in 2008, the SPY dropped dramatically and we just went sideways. I also looked at the same idea and I said, okay, well, what about if we do this on Bitcoin and we just buy when the 10-day moving average on Bitcoin is above the year-to-date anchored VWAP, and we sell when it's below, and we beat the overall market by like 5,000%, right? So again, the point of these kind of articles as I write them, and the point of kind of extrapolating these out, is to show you how you can start to go through and build kind of trading styles and philosophies. So we tie it all together with this one right here, and we say, I'm going to buy when the 10-day moving average crosses above the anchored VWAP, but only on stocks that are strong. And I define strong as the sloping 200-day moving average. Again, check out the last video, check out the last Substack for the math that we do behind that. And again, you can see it boosts performances again and does an amazing job of just completely staying out of bear markets, which if you can develop any strategy that keeps you out of bear markets, but then it gets you invested again when markets get bullish, not only do you boost returns, but it means you could do something else with your capital in these bear market times, right? You could trade shorter term strategies. You could move to income bearing instruments, things like that. So that was kind of the synopsis behind it, right? Proving that we have some statistical advantage trading the anchored VWAP from year to date. So one thing that we've built into Trade Ideas recently, and the link will be in the description below, is an anchored VWAP scanner that updates in real time and draws the anchored VWAP for you. So as I kind of click through these, you can see that it's going to be drawing the anchored VWAP from the year to date. And this scan is basically looking for stocks that are very, very close to that. So this is where I think you can take a statistical model like I built, and then you can apply human discretion to it, which is the main point of this video. And then you can go through and kind of know that the statistics are going to be on your side when you're placing trades and building a trading style or philosophy. Essentially put, what if we take the old kind of bull flags and bear flags, which, there'll be a video about actually next week, but instead of just saying, hey, I'm going to buy anything that kind of resembles a bull flag, which is a push up, and then this kind of consolidation right here, or a bear flag, which is a push down, and then some consolidation right here. But what if I combine that with the year-to-date anchored VWAP? What does this get us? So IQ is a perfect example here. So if you go back to the study, you say, okay, I want to own things that are above their year-to-date anchored VWAP, and I want to stay out of things that are below their year-to-date anchored VWAP. Well, if you look, this is a pretty typical kind of bull flag or a pennant, whatever you want to call it, in IQ. We had a big push up from $2 to $8, and now we've just kind of been consolidating sideways. But we can find this from the year-to-date anchored VWAP scan, and we can say, well, this particular bull flag, I may put a little bit more weight into than, say, for example, a bull flag that just is happening randomly. Maybe it's under its year-to-date anchored VWAP. Maybe it's the low of a move or something like that. But being able to combine technical indicators and analysis with statistics, I think is really what kind of pushes us forwards as traders. So again, the idea is simply, when you're reading these things, when you're looking at the statistics and the kind of the math that I do, I never want to convince you into a style of trading. That doesn't benefit me, and that's not the point of this. But what I want to do is I want to kind of separate what I'm looking at and what I'm doing from a lot of the other channels and people out there that say, okay, this is how you trade. You take this moving average, and when it crosses that moving average, then you're going to make money. But what I want to do is first say, okay, what does the math tell us? What does the statistics tell us? Now, on top of that layer of statistics, you can add in whatever it is that you want. So if you want to then add a fundamental thesis, and you want to say, here is the statistics, I'm going to then add a fundamental thesis, and then I'm going to use technical analysis for risk management, I believe that you'll be way better off. So the kind of takeaway I want you to think about is that go into your own trading and take a look at it and say, hey, these are my last 100 trades or 100 investments or something like that. What would have happened if I had the same fundamental thesis? Maybe I thought AI was going to be great, but then I only bought AI plays that were above their year-to-date moving average, how would that affect your returns? Or say you're a moving average crossover trader and you're buying 20-period moving averages when they cross 50-period moving averages. Just go back through your trades and say, what would happen if I only did that if they were above their year-to-date anchored VWAPs? If it boosts returns, then you've now added a layer to your trading that should hopefully keep you out of bearish markets or more choppy markets. But as always, do your own testing. If you like more of this content, again, subscribe if you're interested in the Substack and all of that. Link is in the description below. I will talk to you guys later.